All right, folks, welcome to the Public Podcast. I'm your host today, JD Durkin, here with you to discuss key takeaways from the Federal Reserve's minutes, the latest drama with the debt ceiling standoff, and is there ever drama, as well as what the economic implications are for you and other American families, as well as what the slump in sales for luxury brands signals about the health of the global economy. As always, do not forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that help you keep your portfolio on track. With us today, one of my favorite guests to talk to about this and all things markets related, Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. Hey, Danielle, thanks for joining us.
It's great to be here today. Fed
Of
day,
course.
another Fed day.
Another Fed day, another Fed minutes day specifically here. So officials a bit split perhaps last meeting on support for more hikes, of course, stressing as always, data dependency. We love that phrase because the Fed loves that phrase. And officials indicating cuts unlikely, at least for the year. Give me your takeaways. What more did we learn here from the Fed minutes, Danielle?
Well, I think you have to back up a little bit right before the Fed minutes came out to who I consider to be Chair Jerome Powell's chief lieutenant. That's Christopher Waller. He's on the Federal Reserve Board. I look at him as being the closest thing to Powell's own words. And he actually said, let's keep a June rate hike on the table. And, we did see the future probability for a June 14th subsequent quarter percentage point hike rise above 34% today after those Waller comments. They stayed there after the minutes because the minutes were very economist-like. They said that most of the members wanted to preserve the optionality to raise rates and obviously, to your first point, not begin lowering rates anytime soon. Again, this is not what markets want, obviously, but it is beginning to be what markets are pricing in. And that's exactly what they've done, for more than the last year or so, is if they don't like what market participants are anticipating, they just change the narrative.
And of course, when you talk about the markets on a week like this, Danielle, you know better than anybody, it's not just the words of Fed officials. It's not just the minutes. We're also dealing with this standoff of a potential debt ceiling crisis here. House Republicans and the Biden administration so far still unable to reach a deal. We've gotten some indications, okay, maybe the previous meetings, the last couple chit-chats have been more positive in tone. We still could be pretty far off from a deal. What is the economic risk if the U.S. fails to raise that more than $31 trillion debt limit, and how worried are you?
Well, at this point, I'm pretty worried, and it's not just because of what you would think of as being a set of holdouts on one side of the aisle or the other. From what I can tell, it seems like the one who's most willing to try and negotiate here is the long-term senator, the former Senator, President Biden. But when it comes to whether it's people in the Freedom Caucus and they're listening to Trump's call to not bend on spending cuts, or if you're listening to the people on the far left, the progressives, they're not willing to bend on any spending cuts. In fact, they want to raise spending. So I understand that it's part of the kabuki theater of debt ceiling standoffs. We've had so many of them over the years, but this one feels a little different to me. And I hate to say this time is different, but it seems like the more they reassure us that they're making progress on the talks, the more we don't see any progress being made.
Danielle, we know what the even threat of default meant back in 2011. We didn't quite get there, but we did come pretty close. This time might be even closer if we don't already kind of hit a default, at least briefly. From where you sit, what do you think this means for our nation's economic prowess on the global scale?
So I think something that's important that's come out kind of in the last 36, 48 hours are measures that Treasury Secretary Janet Yellen can take in order to buy herself a little bit of time if she does end up bumping against basically having the nation's checking account hitting overdraft. There are things that can be done. You can slow spending to certain areas of the economy. I know we don't want to talk about things like shuttering the nation's national parks when school's just getting out or closing the Smithsonian, but there are other types of non-essential government spending that we would think of in terms of, not the FAA. We need to keep the air traffic controllers working, but there are other government employees where you can push a pause on spending them, on paying them. And then once the debt ceiling is resolved, they retroactively get paid. So they technically don't lose a dollar, but Yellen is able to theoretically buy some time. She does not want to talk about these options because she wants for the negotiations to stay very heated and be resolved so she doesn't have to go there.
And Secretary Yellen's also put a little bit of cold water over any 14th Amendment related chatter, but you'd have to imagine that's really a last ditch effort, if it's realistic at all, to rely on one provision from a post Civil War amendment, which is relatively unrelated, to try and be used to follow a solution here. Secretary Yellen and others have said, look, at the end of the day, Congress needs to do its job. I do want to get your perspective on the intersection of this conversation with the Fed. One thing we just learned in the recent Fed minutes is that they said, hey, a timely debt limit increase is essential. Danielle, how closely do you think Fed officials are watching the drama play out on Capitol Hill?
Oh, I mean, gracious, they have to be watching this very, very closely at this point. We are seeing the many sectors, many parts of the economy really slow down hard and fast, as opposed to the slow crawl that we've been seeing for the past few months. So there definitely is a sense, especially in the C-suites among CEOs, CFOs, that this could be a very bad moment for the United States. And, worst case scenarios, of course, that we start to see an escalation in job losses because of this. So with the Fed having the second mandate of maximizing employment, they certainly would be paying attention to this. In the summer of 2011, we saw a very quick 17% sell-off in the stock market. We saw long-term treasury yields come down quickly, and we have to bear in mind at the same time that the Fed continues to shrink its balance sheet, pulling another source of liquidity out of the markets. So how the debt ceiling, how this standoff plays into monetary policy is very crucial at this point.
Some of the big players responsible for negotiating today maybe did not have the positions that they did in 2011, but a lot of members of Congress have been there and have seen this before. And I'm curious, from your perspective, Danielle, what is that historical precedence for overall debt defaults, especially given the unfortunate comparisons we're now making to what happened in 2011?
Well, I think what it tells you is that if politicians dig into their positions, that you really can take the nation towards the brink. But I would say that even in 2011, there were no cuts to entitlement. There were no reforms undertaken. That's precisely why on August the 5th, 2011, Standard & Poor's lowered the sovereign credit rating of the United States, as if to say, if you're not going to come to the table and be serious about the nation's long-term obligations, then what you just went through, the drama that you've taken the financial markets and the U.S. economy through, that's worthy of a downgrade. We could certainly see Fitch and Moody's come out and follow Standard & Poor's. Most are saying that won't make a difference, but it certainly did back in the summer of 2011.
I wonder, before we wrap up this conversation, Danielle, I know you're a big consumer of business news. Do you think there's anything that might be missed a little bit in the overall media conversation about this important topic, or anything you think that might deserve a little bit more attention that maybe you're not hearing a whole lot about as this conversation continues?
So, the one thing, and I do follow the headlines very closely. The one moment, if you will, that I feel was very important, because we had been hearing House Speaker McCarthy say that progress was being made. Once former President Trump came out and told his acolytes, his closest followers, those who are in the Freedom Caucus, that they should not bend at all on their demands, I think that was a major shift in the narrative, and it was a shift in terms of McCarthy's ability to negotiate, because as we know, he can lose his gavel. It's just a matter of 4 or 5 members of the House of Representatives who can strip him of his speakership and really take the nation to a point where you get higher uncertainty than anything we even saw in 2011.
Danielle, before I let you go, I'd love to get your perspective on a decline in luxury retail. What does this signal to you? And what does it tell us you think about the overall global economy? And what is the China component in all of this?
Well, I think the China component has really been overlooked here. Chinese officials have they keep a very tight leash on data that are released, but they allowed the world to see that their manufacturing sector had sunk back into a contraction. And now that we're hearing that most of the travel that's come after the reopening has been domestic in nature, you're starting to see how a lot of these luxury good makers are not going to be beneficiaries necessarily from the international travel that they were hoping to get. One of China's closest trading partners, very dependent on exports to China, Germany. Every bit of data that we're seeing coming out of Germany is increasingly flashing that the German economy actually slid into a technical recession. Once they come up with the revisions, Germany's GDP printed negative in the fourth quarter of 2022. It printed unchanged in the first quarter of 2023. But again, that was before these revisions came out, and we were seeing confidence absolutely crumble in Germany. And I looked at that as being a bellwether reflection of how strong or not this Chinese reopening is.
That's great context. Danielle, finally, anything that you think investors should be paying perhaps a little bit closer attention to that might not yet be getting nearly as much attention as, let's say, Fed minutes, Fed policy, or the debt ceiling?
So, I still see quite a bit of complacency in the market. We track weekly jobless claims. More than 2/3 of states now have rising initial jobless claims. That's about 80% of the population. Even on the continuing claim side, these are Americans on the sidelines collecting unemployment benefits. We've got 80% of the states with individuals who are collecting unemployment benefits. There's something to be said for ignoring the real economy and what's happening and just listening to a lot of the sell side analysts say, no, we can still engineer a soft landing. I think people should be paying closer attention to real time data, including jobless claims, including the weekly purchase applications for mortgages that we saw this morning come out and hit nearly a 30-year low. We have to pay better attention.
Danielle DiMartino Booth, I'm grateful for the context, perspective, and your time as always. Thanks for joining us.
Thank you for having me.